It is so important that you take the time to work out the numbers on an investment property before you buy it. So in this video, I'm going to teach you how to work out the gross yield, the net yield, and the ROI, aka the return on investment, before you buy any investment property, so you can see truly if this is a good deal or if it isn't. If you're using this video to calculate the yield on a property that you already own, then these calculations will show you if your investment falls into one of two categories. It's either an asset or it's a liability. An asset is something that produces a positive cash flow each month, meaning that it puts money into your bank account. And a liability produces a negative cash flow, meaning that it won't be paying you any money into your bank account. It will actually be costing you money to run, even though you've got people living in it and paying you rent. The formulas are very simple and they can be used to assess any property, and I'll take you through them step by step in this video. So if you're new here, my name's Lia, this is my husband AK, and on this channel we talk about property, business and working together as a couple. 4 years ago we started investing in property, and on this channel we've been showing what works and what doesn't work to help you start or expand your property portfolio. So if you're not already subscribed, please click that subscribe button and let's get into the video. Quite often, we see properties go up for sale that are advertised as producing a 10% yield. This is often to attract investors to buy. Now, yield is calculated by dividing the annual rental income by the purchase price and then multiplying that by 100. So if a property produces £10,000 per year in rental income and it costs £100,000 to buy, then that will give you a 10% yield. The problem with this is that it's a gross yield and it doesn't take into account any expenses that you're going to incur, such as mortgage payments, insurance payments, and any management fees, not to mention costs of repairs, and it doesn't count for anything like void periods where your property is vacant and you're waiting for the next tenant to move in. As an investor, you need to calculate and focus on the net yield or the ROI, because this will tell you if you're going to be buying an asset or a liability. It will also enable you to plan ahead for property upkeep, which is probably going to happen, whether it's a few £100s to repaint the walls or whether it's going to be a few £1,000s for a new boiler. So to calculate the net yield, there are 4 figures that you need to know. Number 1, the purchase costs. 2 is the annual rental income. 3 is the finance payments if you've used a mortgage to buy the property. This doesn't count if you've bought it in cash. And number 4 is the operating expenses. We'll need to itemize the expenses on a monthly basis. And for this example, let's use a 3-bed terrace property, which I've recently found on Landlord, where the purchase price is 100k and the expected rent on the property is £800 per calendar month. We'll estimate for this example an expected £2,000 of expenses in legal and mortgage fees. We'll put down here the annual rental income of £9,600, which is 800 times 12, which is simply the monthly rental times by 12 to find out what the annual rental income is. We can use these calculations to find out if it's really a deal or not, because real estate agents will often show you the gross yield rather than the net yield, because it's different for every investor. They're not going to be able to know if you're using a mortgage to buy or if you're not, and they can't predict whether you'll go self-managed or if you'll use management, etc. So that is why they put the gross yield and not the net. If you're not sure what the property's potential rental income is, so you can go online and research and see what other properties are achieving in the same area, and make sure you're looking for like-for-like properties. So if you're buying a 3-bed terrace, look at what other 3-bed terraces are renting for in that postcode. So we know that the rental income is £800 per month. And if you're purchasing the property with a mortgage, you're going to need to know how much your mortgage payments will be every month. And if you have an application in principle from a mortgage lender, then that will tell you how much your monthly payments are going to cost. If you don't have an application in principle yet, then don't panic. You can use an online mortgage calculator to work this out. I'll put a link to one in the description below that we use. You can have a play around with that and find out how much your mortgage payments are likely to be. For this example, I'm going to be using an interest rate of 6%, which is realistic in today's market when I'm filming this video. There are cheaper products out there and there are also more expensive products, but 6% is a good middle of the road percentage to use for a buy-to-let interest-only mortgage and for the purpose of this video. So let's work out the cost of the mortgage. The amount borrowed on a 75% loan to value mortgage with a purchase price of £100,000 is £75,000. £25,000 of that is your own cash, and that's a deposit, and £75,000 is what the bank is lending you for the purchase. Your interest only monthly payments are £375 per month. So to work out how much you pay for an interest only mortgage, you multiply the amount that you're borrowing, £75,000, by the interest rate, so 6%, 0.06, and that's £4,500. You then divide it by 12 to get the monthly figure of £375. So that's what your monthly mortgage figure is. If you wanted to have a higher loan to value, or if you wanted a repayment mortgage instead of an interest only mortgage, then the cost will go up. And there are advantages and disadvantages to this, but we don't want to go into that in this video because it will take us away from working out the yield and the ROI. Do let me know in the comments if you'd be interested in a video like that. We can definitely film something like that in the future, perhaps get a mortgage expert on the channel to discuss those from their point of view. Now for insurance on a buy-to-let, one recently that I have just done for a family member was about £240 a year, so around £20 a month, but it does depend on your postcode of the property, and you can get an idea of this by looking at comparison websites online. Insurance really varies. It can depend on things like crime rates in the area, the type of tenant you've got living in your houses, so it's best to just go online and use comparison websites and get on the phone and get some quotes for that. For this example, we'll go off one of my recent ones, which is £20 per month. Now, a property management company or a letting agent typically charge around 10% for a full management service plus VAT, and that will work out to £96. So 10% of the rent is £80, and VAT at 20% equals an extra £16 on top, making it £96. For repairs, we'd like to put aside a minimum of 5% of the monthly rental income, and in this case it will be £40. That should be the absolute minimum that you put aside. The age and the condition of the property will have an effect on how much you do need to spend on repairs, so you'll have to give it your best guess. There's no exact science on this, but what you can do is keep a record, and over time you'll be able to look back and adjust that percentage if you need to. For void periods, we put aside 8% of the total monthly rental income. So in this example, it would be £64. And the reason that we use 8% is because over a 12-month period, it will accumulate to just under a month's worth of rent. So that would be £768 as opposed to £800. If the tenants did decide to leave at the end of their tenancy and not roll it on, then at least you've got a little bit of money there to cover the monthly mortgage and operating expenses. Bearing in mind, we wouldn't have any managing agent fees because the property will be empty. And hopefully, the managing agent will then find us new tenants within the month and we'll be back up and running as usual. But it is a really good buffer to have, and it's good practice to put that money automatically aside. So then if you do have to touch it, it's there. Adding up all our expenses, we get to the total of £595. And when we deduct that from our rental income, we're left with a balance of just £205. I'm sure you'll agree that that is not a life-changing amount of money to receive from one property monthly, but it is better than zero. And don't forget that with property, we are talking about the long-term gain as well. On average, houses double in value every 10 years. Do consider the capital appreciation before judging all of that work for just a £200 cash flow. Now we're able to work out the net yield, which is the total net income divided by the purchase price of the property and multiplied by 100. And in this example, we get 2.46%. It is a lot less than the 9.6% yield that I mentioned earlier. But remember that that was the gross yield, and that percentage doesn't take into account any monthly expenses. Albeit small, it is a cash flowing property. Moving on to the ROI. You'll notice that in my breakdown of figures earlier, I added the £2,000 of legal and mortgage fees expected. So some people don't like to do this, but I like to incorporate it into the calculations because it is cash that is leaving our pocket. So it's coming out of our account. It's all part of the investment. So that takes us on to the last calculation, ROI. So working out the return on investment. ROI is the annual net income divided by the cash left in the deal, aka the money you've put into the property, multiplied by 100. This gives us an ROI of 2.4%. So this is not great. And for anybody who watches our channel, we all know that we focus on an HMO strategy, which is why our ROI has to be closer to the 20, 25%, 30 mark, simply because we use OPM, other people's money, and we pay themselves and we pay ourselves. Can you see how working out the ROI is actually really helpful, because it allows you to analyze if something is stacking up as a deal or if it isn't. Some properties may come with additional expenses. For example, with our HMO properties, we pay all of the bills and we provide an all bills included package to our tenants. So there's a lot of additional lines of expenses that have to be baked into the equation. So if you're working out something a little bit more complex like HMO or flats where there's ground rent, you now know how to do the calculations. You just need to put in the extra lines for the other expenses occurred. And I just want to go back to what I was saying earlier about looking at the long-term picture for property. Although someone might not look at a deal which is cash flowing £200 a month, somebody else might actually think that's a fantastic deal for them, and they might be looking more at the fact that house prices double on average every 10 years, and they might be looking more towards the capital appreciation on the property. So just because something's not a deal for me doesn't mean it might not be a deal for somebody else. We're all in different situations. Some people are buying with a mortgage, some people are buying without a mortgage. So this video was purely to provide you with the calculations for working out a gross yield, a net yield, and the ROI. So I hope you found this video helpful. Please let me know in the comment box below if you've got any questions on working out any of those calculations. And please do head over to our website, propertycouple.co.uk, for more information and free resources such as downloadable PDFs. There is a lot of new stuff coming your way. If you're interested in any property coaching or mentoring, there's a work with us link below in the description too. If you fill out that form, we'll get back to you personally. If you haven't already subscribed, please do that too, and give the video a thumbs up. And we'll see you in the next one. Take care, everyone. Bye.